and advisor to Ego Death Capital. Super honored because these are all household names and macro gurus. So first of all, you know what? This is where I'm going to start this conversation. Learning about Bitcoin sent me down the macro rabbit hole, and normally I gobble up all of the macro interviews on YouTube and on all the podcasts, and lately I've just felt fatigue. I've felt fatigue with asking the questions and listening to some of the shows because it seems like all of them are repeating the same topics. When is the recession? When are things going to systemically break? When is the credit event? Why haven't we, we initiated the money printer again and reversed the policy. So can we zoom out for a second? Can you set the scene? And anyone can start. Let's, be super casual about this. Where are we at right now? And why haven't things, quote unquote, broken?
I'll start with, I was the one that provided that video because I found it absolutely hilarious, and Yellow does such a perfect job, I think, kind of encapsulating what Natalie just said, which is there's a lot of fatigue and frustration because you'll listen to shows, and I know I'm guilty of this and many others are as well, where we get all excited and we're talking about macro and we're having these in-depth conversations about valuations and whatnot, and that central bankers are breaking the world, but yet it just seems to inch along and nothing's actually truly breaking, right? And I think that if I was going to really zoom out and describe why is that the case, it's because these cycles, they don't move quickly. For people that are maybe just coming into this and they've heard some of these conversations, it might feel and it might sound like it's going to happen tomorrow or it's going to happen in a month. And the reality is when you look at the sheer size of Bitcoin and you look at the sheer size of the legacy financial system and all these trillions upon trillions of fiat units that are in that system, the one's microscopic and the other one is just an absolute behemoth. And so the analogy of a speedboat and a cruise liner and turning a speedboat and turning a cruise liner is probably very apt to describe why these cycles take so long to kind of play out. I was doing a discussion over here on the side before we came up here, and not to dive into the nuances of some of these charts and really more obscure ideas, but 30-year versus a 3-month bond, when you're looking at this chart and you look at it over the last 40 years, once that negative inverted where you're getting a higher yield out of a 3-month note compared to a 30-year bond, which doesn't make any sense to anybody that's hearing that, but when that goes negative and it actually starts to reverse itself, we haven't seen a bottom in equity markets for 600 days, basically 2 years after that has been bottom and it starts to go the other way. We haven't even seen that yet, right now. And that spread between 30-year bonds and 3-month notes just continues to go deeper and deeper negative, the difference between them. So when I'm looking at this larger macro picture and we're having these conversations that things are going to break, sure they're going to break. We saw Silicon Valley Bank and some of those things breaking, but they're continuing to put these patches on the dam, and then there's just a new hole that pops over here, then they stand up another backstop facility. But when we really, really zoom out, I'm of the opinion that a lot of this has a lot more time to kind of manifest itself, at least from traditional markets. Now, when you talk about Bitcoin and the implications of what happens to Bitcoin with all of that macro backdrop, I kind of think that some of it is overlapping, and Mark, you do a great job talking about some of that stuff from time to time where you have this macro backdrop that's creating a tailwind to something that's naturally happening in the organic Bitcoin cycle, and then sometimes it's at odds with it. And I would argue right now, over the last year and a half, we've had intense selling pressure in Bitcoin where actors that I view as being bad actors, SBF, Three Arrows Capital, the Luna, just all the altcoins that sucked up a lot of the speculative interest that in previous cycles would have gone into Bitcoin. All of that is unwinding. You could even make the argument that Binance could potentially be the next addition to that long list of quote unquote bad actors. And so we're a year and a half into that, just from a Bitcoin standpoint, and that selling pressure is eventually going to come to an end. And I think that might be in a different time frame than all this macro backdrop that we're talking about. And so once you get so much sell pressure and so much suffocation, and I'm sorry I'm going on and on, but this is a very high level, and we got a lot of time. There's the sell pressure is going to eventually fizzle out, and because there's nobody adding more units of Bitcoin, the buying and the accumulation and all of that Bitcoin nesting itself into the hands of very strong-handed individuals like the people in this room that have a ton of conviction, that's going to drive a bull market, sometimes regardless of what's happening in the backdrop with the macro. So you got to really kind of, I think you got to look at them in two different buckets. Sometimes they're complementary, sometimes one's providing a huge tailwind to the other, and then other times they're kind of going in two different directions, and it can get kind of foggy or unclear, and that's where you get the sideways movement a lot of the time. So.
I'll let them weigh in, but by the way, if you liked Preston's answer, you can zap him right now on NOSTR.
Do it. Zap him.
If you see the zeros on top, that means no one's zapped. So it's kind of sad right now.
Going back to the kind of original question, like it looks like something's breaking and when is it going to break and things like that. The first thing you have to clarify is, what is your definition of breaking? Because I was given this example, actually, it was a few months ago. One of my buddies was texting me sort of frantic, and he's like, what does this news mean? Am I going to wake up one day and find that my dollars in my bank buy me half as many goods and services? I'm like, they already do. Just look at the last 3 years. Houses went up by 50%. Gas, steak, milk went up by 50%. They already do. Like, it's all, what you're afraid of actually just happened. And so it's really easy to look at like the Turkish lira. It's lost 95% to the US dollar in the last 5 years. It's crashing. Argentina, the currency's crashing. Venezuela, Lebanon, we can go down the list. All these currencies are they breaking? What's the definition of breaking? And then you go, okay, well, if they're breaking, but then the dollar's lost 65% to the S&P 500, 45% to the US median real estate, et cetera. So it's already breaking. How else is it breaking? Well, the Fed's broke. The Fed is now losing money. They're no longer paying the Treasury. The US government is now broke. And now the banks are broke. So what is the definition of breaking? I would say it's already broken. Now, if your definition of when will it break and no longer cease to exist, well, you may be in for a sad surprise, because that might not happen. So for example, the dollar took over the reserve currency status from the pound sterling 100 years ago, but the pound sterling is still the third most used currency in the world today. So the chance of like, and really, I mean, there's different levels of this conversation. I think we're witnessing currencies breaking or disappearing left and right now. Eventually, yes, the U.S. dollar, is going to continue its downward trend. I think the bigger picture is the international monetary system that we know today. The fiat monetary system is breaking. But I think again, it's just this continual decline, and it accelerates. But yeah, what's your definition of breaking? I guess is what I'd say about that.
Yeah, and we don't want the system to just break. I mean, if we had the system just fall apart, that would be catastrophic. That would not be fun for anybody. Even all the Bitcoiners who have their 6.15 in cold storage, it would not matter. It would be a really bad event. So, but, there's a lot of different ways to pull this apart and unpack it. And many of you in this room, you own Bitcoin because it's an investment. Many of you own it because you just believe it's a great savings vehicle. It's where you should save your money. Many of you believe that. Oh, okay. Is this one terrible? Yeah, it's garbage. Okay. So they gave me the garbage mic.
Grand Poobah.
Yeah. Thanks, Gary. So anyway, so the bottom line is, you come to Bitcoin a lot of different ways. I mean, I came to Bitcoin as an investor. That's where my background is. I've been in hedge funds and private equity for 30 years, and I saw Bitcoin and understood it in a different perspective. But I can tell you from that perspective and pulling back and looking at this market and talking about what Preston and Mark are talking about, this is the most difficult market I've ever looked at from an investor perspective. This is really, really hard, right? So you've got so many forces that are working against each other and pushing each other on a system that is more levered than we've seen in a very long time, any of our lifetimes, right? So the issue here is it's going to break. It will break, but will we have a parallel system along the same lines that we can use while this other system is kind of coming offline? Or can we just run those parallel systems forever? You know, whether it's a US dollar that we're going to use as a means of exchange, and then you have Bitcoin and the Bitcoin ecosystem and the Bitcoin protocol, that all these different things that Mark was talking about in his speech just a little while ago that are built on top of. Well, that's our hope, that we get that built, and that's what we're all here for, is to try to help people understand that. But going back to what Mark was saying, you know, we can come to it from a perspective of we see Bitcoin as an investment. We're U.S. centric. We have this tremendous benefit that we are using the reserve currency of the world. That's pretty. We're fortunate there. You know, we don't need Bitcoin. But people in Lebanon need Bitcoin. People in Argentina need Bitcoin. People in Venezuela these people need it. And so when you look at timelines, we're all on different timelines in our need for it and what we expect from it. And so just looking at it from that perspective, just remember to pull back. And I'm not saying be patient for the destruction of the U.S. and fiat world, because I don't think that would be a great event. But we do want Bitcoin to grow organically, and it is happening. It's just on that pace in the beginning of that parabolic curve that Mark was talking about.
To Mark's point, where he was saying that it's your definition of breaking, I think is a really important point. And what I would challenge people that when they change the unit that they're using to look at the overall system, whatever their investments are, let's just say you're investing in the S&P 500 index. When you're looking at it and you're just denominating that in dollars, the chart just looks like it's parabolic. And so for a person who's, let's say you're having a conversation with your family member and you're saying, oh yeah, I listen to these Bitcoiners and I listen to this macro panel and they say everything's breaking. That family member is saying, well, I have money in the S&P 500 index and it's just going straight up. It's doing quite well. It was down a little bit in 2022, but it's doing quite well this year. That's the comeback, right? But when you take that performance and you M2 adjust that performance, meaning I'm taking that dollar and I'm going back throughout time. Let's say I look at the last 10 years of the S&P 500's performance and I redenominate each one of those discrete moments in time with the amount of dollars that were in the system at each one of those discrete moments in time. All of a sudden, that performance is actually going sideways and slightly down. And I know most people in here probably have a TradingView account. It's real easy to create this chart. Just go in there, type SPY, which is your ticker for the S&P 500, put a division symbol, and then I think the ticker for the M2 is M2SL. Just put that in there, hit enter, look at the chart, and you'll see the chart is like going sideways and slightly down. That's your actual performance of the S&P 500. People that have seen the housing prices double, right? Everybody's like, well, yeah, but I'm not, like, if I have to move right now, especially if you don't have your house paid off, let's say you have 20, 30% down on the house and the rest is debt, and you want to move out of that house that just accumulated in all sorts of value, and you want to buy a new house, congratulations. Your lifestyle is going to get worse as you transition to that new house. That's where you're seeing the reality of this situation that seems to be masked in a very superficial conversation when you're talking about the system isn't breaking.
Well, I'm really glad you brought that up because I just pulled up a report that came out from, if you guys follow the Kobaisi letter. Median cost to buy a house hits a new record of $2,748 per month, up a massive 90% since 2020. In other words, buying a house today costs nearly $33,000 per year. This is 46% of the median pre-tax household income in the U.S. Post-tax, home buyers in the U.S. are spending nearly 70% of their income on home payments. Meanwhile, the median monthly apartment rent just hit a fresh record of $1,859 per month. How has it become this difficult to have a place to live? So let's touch on that a little bit because I think there's a lot of gaslighting going on, right? We're hearing we have a very strong economy. Inflation is coming down. The labor market is hot. What is the truth behind what we're being told?
Go ahead.
Yeah, the labor market's hot. Everybody's working and they're all making $1 an hour. Full employment means nothing, right? Not if everyone's working for $1 an hour. So there's a lot to unpack within that number. So sure, unemployment's low, but the labor force participation rate is also very low, which means a lot of people aren't working. We also know that the people are working that are fully employed are working for lower wages. And so the problem is that the quality of life is going down because asset prices are going up faster than your wages are going up. And so that's like the big thing. So while they want to tell you the headlines, to Natalie's point, they're gaslighting you with data, with facts. I call it, I call it factually correct but intellectually dishonest. Because yes, that number is factually correct, but it doesn't really tell you the context to understand what's going on. So yeah, in that example, who cares if everybody's working if they're working for low wages as asset prices are going up? And the other thing is that when you're looking at things on micro levels, you also don't see these big moves. So home prices had gone up because the overall payment of the home went down because interest rates were so low. But now they've jacked the interest rates way up, which has pushed the prices up. But that doesn't even really tell, even that letter doesn't really tell the full picture because you can see that home sales are at all-time lows. No one's selling because most people locked in 2% and 3% mortgages. And so that's one of the reasons why the housing market hasn't really been impacted as much as a lot of people expect it to be, because those people that locked in those rates haven't really been affected. And so even to that report, while that is correct, most people aren't paying those payments because they're locked in. Now, it does affect you if you want to buy a home, certainly. And that's why that activity is very, very low. But yeah, these are all forces that are happening under this fiat money system. If you look at WTF app in 1971, you see all of these stats. And so, for example, you can see the cost of living go up. And really the way that I like to measure it and the way that I talk about it is like stealing your life. And so really, if you go back and look, what is the average wage and how many hours does it take them to buy the average car or the average house and things like that? And so that's one way to look at the productivity. And you can see that it's taking, at 8% inflation at a $32 average wage, it takes 10 more hours per month to have the same standard of living that you would have had to have the month before. That's 10 hours of your life that were just taken that could have been spent with your wife, your kids, a second career, your health, etc. And so they've literally stolen that from you just to maintain that quality of life.
And not just that, but you're talking about full employment, the participation rate, but also many people have more than one job, and that's a problem in and of itself, right? But let's go back to inflation, okay? Inflation in the U.S. is typically measured by a segment that's called the CPI, okay, and it's a measure.
CPI.
CPI, right, and by the BLS, which we shorten to BS. So, but the problem here is that it's a measure that they use to gauge what inflation is, okay, and so they put this out repeatedly, like very regularly. You get this inflation gauge, okay, and you hear what this is, but it is a lie. And why is it a lie? It's a lie because the United States needs inflation, okay? They need inflation to continue. They just can't let it to get out of control. It can't rage out of control. We can't have hyperinflation. Why? Well, you need inflation because we operate in a perpetual deficit. We are always borrowing money, okay? We don't make enough money in productivity in order to pay for all the expenses that Congress has agreed to, has put into legislation. We just can't meet those needs. So we have to borrow more and more every single year. But we're borrowing so much, the debt is growing so much. We borrowed, what, $1 trillion in June? Yeah. I mean, in June. So we're up over $32.5 trillion of debt in this country. And we've got unfunded liabilities added to that, which puts us at about $200 trillion in debt in this country. So we're talking about the everything bubble. The problem is we will never pay that back, ever. The only thing we can do is keep kicking that can down the road. So going back to CPI and the measure of inflation. Well, they're gaslighting us. They're telling us that inflation is down to 3.2% from last year. Raise your hand if you think that your groceries are up 3.2% from last year. Are you effing kidding me that that's the number they're giving us? Really? Okay, but they're telling us that. They're telling the world that. Why? To instill confidence in those treasuries. Because if you're going to loan the U.S. government money for 2 years, 10 years, 30 years, and you're going to get that principal back after those 10 to 30 years, and that you've been running inflation at 5, 7, 10% over those years, what do you think that those dollars are worth when you get them back? Not a lot.
Less.
Yeah. Mark and I were having a conversation earlier, and we were talking about the BRICS and why we think that this is a really important macro theme and something that is a major pivoting point than what we've seen in the last 40 years. And I don't know if people saw the headline, it was just yesterday or the day before, where it's not just the BRICS nations. Now you have Saudi Arabia, you have the UAE, and you have Iran that's looking to join. And when you combine all of them together, they make up 80% of the production of oil. When we talk about CPI and we talk about this keystone of valuation, which is inflation and how much these monetary units are expanding, beneath that, right, is energy itself. And any Bitcoiner who really grasps why Bitcoin's important, you know it's backed by energy, encrypted energy. And so when we talk about oil and how it's this number one input to move, like if you have crops, how are you harvesting those crops? How are you then transporting those crops to where they need to go? If you're pulling metals out of the ground, what machines are you using to do that, and how are you powering those machines? So when you think about oil and you think about this energy and you think about the people who actually control the amount of supply that they can put onto the market versus the natural demand that's there, when you have 80% of the people that are supplying that critical input, and they're now saying that we're going to team up together and we're not going to be aligned with the United States, that is a very, very big deal. Because when you look at this treasury market, that the treasury market that central bankers, G7 central bankers have been working together to control the price of that money, regardless of what's happening with energy, it was almost like they were able to wag the tail of the energy market. But now all of a sudden you have this unification of all these producers of energy that, in my opinion, and many other very smart economists, Luke Roman being a very vocal person on this particular point, he's saying now that they're starting to unify, all of a sudden the ability of the central bankers to call the shots, no more. This new entity over here that's controlling the price of oil can actually dictate the price of treasuries and euro bond markets and Japanese bond markets, because they're the ones calling the shots. And it's a massive shift than anything that we've seen. It may take time. I know Nick does a really great job talking about this, and this is something that Mark was talking about earlier, is you have to understand the timeline. Right? I'm not saying that this is going to drive treasuries in the next year, but in the next 10 years, I think we're going to see some fireworks take place, because they can't control. If you can't control the treasuries, you can't control the price of money itself, which means you can't control the price of everything. Everything you buy when you go out to a store, how you spend your money day to day. That's what this is all about.
And this is a macro conversation, which by definition means a very big picture, wide view. So that's what we're talking about. the way too often quoted, great one, Wayne Gretzky, of skating to where the puck is going to be, so to speak, right? And so really what I'm always looking for, and I think most of us, and I think what all of you should also be looking for, is the directionality. None of us are traders. I mean, even James, who spent his career on Wall Street, I don't think you would consider yourself a day trader. Like, we're not looking at each piece of information as a tradable or actionable event, but rather it's to see the directionality of the world so we can be in position for that to happen. Kind of like Charlie Munger said, that the big money is not made in the buying and the selling, but in the waiting for these developments to happen. But kind of back to what Preston's point is, it's even a bigger deal because not only are they ganging up, and it's 80% of the world's energy, and so the whole world moves off of energy, which again, back to the CPI, they give gas like 3.5% of the CPI basket, but it's probably the single most important ingredient in the entire basket because the whole economy moves off of energy. So if the price of gas goes up, the price of every other thing in the basket goes up. So anyway, that's kind of crazy. But if 80% of them, so that's one thing. At the same time, we have the United States, who's also a major oil producer, trying to shut that off. The United States has goods and services that we export like every other nation, and we have our GDP, which is pretty massive. Now, if you break it down into goods and services, the services are mainly financial and social media services. Putin called out the United States and said, what are you going to do? Eat your social media stocks? Ha ha. So the main three exports of goods that we do is energy, oil. And so if our main exports are oil, 80% of the world is kind of cooperating, and we're trying to shut ours off at the same time. Where does that lead things? From this macro picture, which direction are we going? And you kind of start to see, how does this treasury market get backed up by a country who no longer has energy and has now been co-opted? And then the last piece I'll add is that some of the rhetoric that came out of this BRICS meeting last week was very antagonistic in a sense where they said that we are encouraging and emphasizing all of the nation members to do trade in their own currencies, meaning outside of the US dollar, one. President Xi of China said that he wants the BRICS to outcompete the G7. So Preston just mentioned the G7 that used to have control over the treasuries and the oil. Well, now we have 80% of the oil being over here, and they're specifically saying their goal is to compete with. That's a lot different than cooperation. That's coercion. So now we have to compete. No more free trade. So this is what's happening. And to Preston's point, I would agree. This is over a 10-year time. This is a macro conversation. This is the directionality of where we're going.
And the G7, the GDP of the G7 doesn't even match the original BRICS nations, the Brazil, Russia, India, China, South Africa. So when you add UAE, you add Iran, this is a massive jump up in like you were talking about with oil. I mean, so one thing though, yes, BRICS it's a kind of a warning sign, okay? But this is not happening overnight. They have structural problems themselves. I mean, they can't even trust each other, right? So that is a major problem, and I don't see them as trying to create the new world reserve currency. But I do see them trying to get away from the dollar, and it's obvious why. When Putin's treasuries were seized by the U.S. government, when they were cut off of SWIFT, the messaging/payment system, and they couldn't transfer U.S. dollars, they realized, well, we've got to get out now and have our own system. Okay, and then it just sent a signal to every single country around the world who's not perfectly aligned with the United States that if you don't do what we want you to do, we'll cut you off from the system. So what does that make you want to do? Well, clearly have your own system. And so it isn't nothing. It is absolutely a warning sign, and it could absolutely grow into something that pulls a massive amount of trade outside of the current system. And why that matters is because everything right now, as Preston said, is based on treasuries. And if the U.S. Treasury market starts to falter, that's when you see the cracks begin to appear in the United States, in not just our financial system, but then the system across the world. So the U.S. Treasury market is absolutely king. It's essential for this whole fiat system to continue. And that's kind of the signal that we're all looking for. If there are problems there, then there are problems that we cannot overcome.
Well, I'm actually glad you made that point, James, because right now the dollar is still so entrenched globally. 80% of transactions, most debt denominated in dollars. So we're at the very beginning phases, but we see this happening. However, you also have to acknowledge that even a couple decades ago, people were talking about de-dollarization. And I don't know if you saw this this tweet people were talking about from Peter Zeihan. We're all familiar with him, right? He said some stupid things about Bitcoin on the Joe Rogan show. But he said, have you ever seen a couple of 3-year-olds sitting on the playground talking gibberish and acting like they're making life-changing decisions? That's what's going on at the BRICS summit in South Africa this week. He names the countries and he says they have limited economic ties, diverse interests, and they struggle to connect on anything meaningful. They have all these extra countries that are applying, but this is the worst, try to come up with a worse list of mid-tier countries to bring on if you want to expand your geopolitical influence. The varying interests of the current and new members will likely halt any meaningful conversation. So, I mean, talk about gaslighting. I mean, these are going to be the messages coming out, that this is of nothing important.
We get messages like this all the time, like, oh, the downgrade of the U.S. Treasury debt from the credit agencies is no big deal. Yeah, it's a big deal. It's a really big deal. I mean, we just fell from one of the highest rated countries' debt in the world down a tier. That's a big deal for a number of reasons. One of them being that if you're an investor and you're worried about having a technical default on your treasuries, then the problem is if you have a technical default, you have counterparty risk. You have collateral at risk. And you can't meet that collateral. It's a big deal, but they're gaslighting us here, okay? You've got the White House, you've got the Fed, you've got Congress, you've got the Treasury, and they all have different goals that they're trying to meet. They all are in their silos. So we think that we have this playground where they're all in the sandbox and they're trying to fight and elbow out. Like the Fed can't raise rates too much because the Treasury is going to default. And the Treasury can't issue too much because then Congress won't get reelected. That's not the way it works. They don't talk to each other like that. Powell says, I have a goal. My goal is to instill confidence in the US dollar. That's my goal. And the way I do that is to keep inflation in check. And our targeted rate is 2%. That's what I've been told to do. That's my goal. The Treasury has a goal. Their goal is to issue enough bonds to meet the demands of Congress's spending. Congress has a goal to get reelected, period. That's their only goal. And so...
And to vote money into their district.
And that's right. And that's it. So to get reelected by voting money into their district and then overspending. And the White House has a goal. We don't know what it is, but they have a goal, okay?
So what James is saying is that they all have independent goals that sometimes overlap, but they also sometimes contradict. And that's exactly what Natalie was just talking about in Peter Zeihan's quote that he said. And all of these nations often contradict, and how can they work together, but they also sometimes align. And in Preston's conversation that we were having earlier backstage, I mentioned how also the same problem persists when you have BRICS, Brazil, Russia, India, China, South Africa, now plus the other member states, but Russia being one of the biggest members of that, probably the second largest, and Putin couldn't even go to the event or he might be arrested in South Africa. So like that sort of shows that. That being said, it's funny, and it does show that like this is going to be difficult, but at the same time, enemy of my enemy is my friend. And when you're coming to kill me and James, we may not like each other, but since both of our lives are in danger, we will work together. And so you have a lot of dynamics you have to understand. Yeah, we like each other, but I'm just saying. But you understand. So while Zion's sort of right, what happens in capitalism is that we can all be free to be individuals, but we come together where our interests align. And while in a lot of ways these countries cannot align, in a lot of ways they can. The other thing I'd say about Zion, I mean, you have to understand the source of the news, and obviously he's like a CIA mouthpiece, so you understand that. The other thing that you have to understand is that it's pretty categorically false. I mean, we can pretty much, he's saying that none of these nations matter. But the whole news media right now is being fed the line that the U.S. is scared because we're being threatened by China being the rival, overtaking. So China's nothing, or they're overtaking the U.S. Which one is it? So China's certainly a global superpower, maybe on par with the US, that's debatable, whatever, but they're certainly there. Russia as well. And so to call them collectively nothing, I mean, that's just false.
I would just say this whole BRICS conversation is the tailwind to the issue that we were talking about at the start of the conversation, which is the math already, and James has done an amazing job kind of outlining this. The math alone, just in the US, being able to control the spending that's needed, the amount of liquidity that's going to be needed to be pumped into the middle class and lower just to subsidize people not to rise up, which we're already seeing some of the social unrest manifest itself. Like all of those issues I would put over here. And then I would say all this BRICS conversation is the tailwind fanning the flames of those issues. So I would compartmentalize both of them separately.
Well, you can't because they actually feed each other.
Well, they do feed, compartmentalize isn't the right word, but I would say look at them as one supplying and fanning the flames of the issue that's over here.
Cause and effect.
Compounding it.
Cause and effect almost.
They're feeding off of each other. Yeah.
Well, while this international summit happened, right now we have our favorite central bankers, including Powell and Christine Lagarde, in Jackson Hole, Wyoming, threading the needle and trying to get us back to 2% inflation, that nice little target that the New York Times opinion column wants to increase to 3%. So let's move back to U.S. policy, because I think that it would be good to sort of give us the difference between monetary and fiscal policy, because I think that's the important difference right now. Is they've contracted the monetary side, and we're seeing fewer, lending. We're seeing more tightness on the monetary side. But on the fiscal side, the spigot is totally open, and we have everything from the ERC program still injecting liquidity, and we have other kind of stimulating factors on that side. So that's sort of, tilting things off balance. So we actually do have more of a bubble and not a recession yet.
Yeah, it's counterintuitive, but when you run deficits, it's inflationary, and so what do I mean by that? Well, you're creating dollars. You're just continuously creating dollars and pushing this debt into the system, into the economy. Okay, so debt. Let's go all the way back. Debt in and of itself is not a bad thing. Okay, if you use it responsibly, all you're doing is pulling future productivity into the now, right? So if I want to go start a company, if I want to go start a restaurant, say, okay, bad idea, but let's say you did, okay? And if I did, and it's going to cost $100,000 to get the lease, to hire workers, to buy the equipment, to get the food. Okay, but if I don't have $100,000, I can either go work my day job until I get enough money to get that $100,000 and then open up the restaurant. Or I can get a little bit of money, go to the bank, get a loan, and then just immediately get the lease, buy the equipment, buy the food, hire the workers, and start generating productivity now. All I've done is pulled future productivity into today. So it's not a bad thing. The problem is we can get over our ski tips with that and have too much debt, which is what we've done at the U.S. level. So going back to what Preston was saying is that, yeah, we are in a path that's unsustainable. The Treasury even admitted it, putting out a chart, and it was subtitled An Unsustainable Fiscal Path, showing how debt to GDP is just exponentially rising in the next 50 years. And they know it. It was kind of a warning signal to Congress, but that's why they put that out. Okay, so, but the issue here is we're borrowing more than we're making every single year. We're pushing that into the economy, right? And then every single time that we have a crack in the system, so go back to last spring, and we're talking about Silicon Valley Bank, and that collapse could have been catastrophic if it was going to touch other banks, if those other banks were going to be, if they were going to fall into bankruptcy as well because of contagion. Okay, it's like a contagious virus in finance, where if one thing fails, another thing fails, another thing fails. And if anybody remembers 1998, back when long-term capital management was about to fail, Well, this is kind of the first time that we ever really rushed in, the Fed really rushed in to save the system, which is partly what you're talking about, is continually save the system. It started back in 1987, okay, when in Black Monday, when Greenspan assured the markets that the Fed was there to help them and keep everybody solvent. That was kind of the hint. Then you move forward to 1998, and in long-term capital management, run by a couple of guys who had actually won the Nobel Prize for creating the Black-Scholes options model. And so these were geniuses, right? Well, these geniuses went out and borrowed 100 to 1, $100 billion to $1 billion, and they shorted volatility. Okay, does anybody know what that means? It just means that if things go volatile, they lose money. Well, what happened? Russia depegged the ruble over the summer. Bonds got super volatile. These guys lost not just billions of dollars, hundreds of billions of dollars. They were going to take down the entire system. So
that was when that used to be a big number.
That used to be a big number, right? So pretended hundreds of trillions. Right. So, but so what happened is they literally went to the Goldman Sachs CEO went to the Fed and said, hey, the head of the New York Fed, and said, if you don't help us here, we're going to collapse and take out everybody with us. And that was the start of it all. And so the New York Fed gathered everybody in that room, and rumor has it that Bear Stearns refused to play ball. And so when you fast forward to 2008, when Bear Stearns needed to be bailed out, Goldman Sachs was like, sorry, pal. So, but that's kind of where it all started. And so, yes, we're having conflicting, you know, we have the BTFP program, we've got, you know, we just continuously injecting liquidity into markets while the Fed is trying to raise rates and tighten things. And so it is working against each other.
So you had this was 97, when was this? 98. 98. So this was 98, then you had the 2008 crisis, right? And then you had the European crisis, which was 2011, 2012 timeframe, right? And then things are pretty stable for a little bit, and then you have the repo situation in September of 2019. And this is where I would argue that everything kind of started coming back to manifest the next global financial crisis, where you're having impairment is about to set in and cascade contagion throughout the global economy, and they step in and they do their repo backstop facility. Then all of a sudden COVID hits 2020 March. They're doing drastic QE and all sorts of liquidity measures into the system. Then you go to September of 2022, and you have the UK gilt market on the cusp of breaking, and you have global cooperation amongst central bankers to backstop all of that and to calm the markets again. Then March 2023, this year, we have the Silicon Valley Bank. So look at the frequency and look at the actions that it's not just one central bank, it's all the G7 central banks that are now globally cooperating together in harmony in order to try to prevent this cascading impairment to come through the market and expose fractional reserve banking for what it is. So what does this look like into the end of the year? We got $1.8 trillion just in the United States that still has to be issued at these really high rates compared to the low rates that they're rolling over, okay? So there's the frequency, the whole point of laying that history out is to show you that the frequency is really picking up, and it's aggressively picking up, which goes back to Mark's original comment when we started this conversation, which is, how do you define broken, right? Their intervention is the signal to everybody in the market that something is extremely wrong. The problem is a lot of people aren't educated around that being truly an issue, because they have swooped in and miraculously threw another trillion into the system, and these numbers are so large that they are incomprehensible to everyday citizens, that they don't even, like, these numbers, like the Silicon Valley Bank thing, was bigger than the numbers of the 2008 crisis by a lot, right? And that was a massive news event. The Silicon Valley Bank thing, I think if you lined up 100 people on the street, 95 to 98%, 98 of them probably wouldn't even know what happened. It's like, what are you even talking about?
Right. We've exceeded a lot of the numbers from 2008 in terms of how much has already been drained out of the system. Mark?
I just want to go back to your original question. You asked about the difference of the monetary
Yeah.
versus the fiscal spending. And I think it's an important piece that you kind of need to understand and pay attention to, because what we have monetary, which is what the Federal Reserve controls with interest rates and bank policy, but then you have fiscal, which is what the government or the Treasury spends into. And the reason why those are important to understand is because what the Fed is doing, what Powell's doing, is trying to bring inflation under control, thinking he can control an economy of billions of people with a single digit of the price of money, which is pretty crazy in itself. But by raising interest rates, he's trying to bring down inflation. But the problem is, inflation is, if we take it for what they mean it to be, the prices of things going up. And really there's two ways to change the prices. So prices are the equilibrium of supply and demand. So we could bring more supply to the market, but of course the Fed can't do that. So what they're trying to do is crush demand. So if they bring rates up, make money more expensive, there's less demand for the goods and services that bring the prices back down. The problem is that affects you guys mostly. But it's the fiscal, so that's the monetary side. The fiscal side, it's the governments that are spending all the money. Pre-pandemic, the US Treasury was spending about 4.6 trillion per year. That increased by about 50% to about, or it was 4.8, and now it's 6.4 trillion per year. Now, what we saw in the last debt ceiling debate is that they argued about trimming the debt, bringing down the fiscal spending, and of course, that could never happen, and so they baked in that new number. So the government, the fiscal spending went up by 50%, which caused massive inflation, and that's the new norm. That's the new number now. So while the Fed is over here trying to change the price of money, and trying to make you guys broke so you don't buy as much stuff, the problem is it's the government. The problem is the government that's the one spending all the money. And they have decided not to bring it back down. As a matter of fact, with the debt ceiling debate, they said now that these numbers are baked in through the next election cycle of 2025. So there's that. And then the other piece I just want to add on to it, kind of what James was saying about the different types of debt, good debt and bad debt. My mentor and my friend Robert Kiyosaki talks about good debt being productive debt if you buy a rental property or equipment for your business, bad debt being like going out to dinner on vacation. And so when you look at the types of debt that are being issued, and so you have productive debt, and so really we live in a debt-based monetary system, so dollars are liabilities. Dollars are liabilities. Debt is the asset. So I want a house, I get debt for the asset. That debt is backed by the house. The dollars are the liability for that. And the problem is, if you or I get a loan on a house, a boat, a car, or a business, at least there's an asset to back that. But when the government takes on the debt and just blows the money into nothing and spends that fiscally into the economy, it's highly inflationary. And then back to James's point about the Treasury's own admission in the report in 2021, it's an unsustainable path. The interest is now higher than what we spend on the military, which is more than the next 10 nations combined. And so it's the doom loop. And so it's debt being accumulated into non-productive assets, which is highly inflationary. Because if the goods and services increase with the rate of the money supply, you don't have inflation. But because of the type of debt that's being taken on and being spent fiscally, it's a big problem.
I was listening to a podcast earlier today talking about the employee retention credit and that program, how much fraud there is, but it's still pumping like 20 billion, 30 billion every month into the economy. But again, these numbers, they're so big, but yet they're starting to feel really small.
And so, employment's a big deal. And so one of the things that the Fed points to, okay, they say they need to keep inflation in check, and they're supposed to keep high employment, right? That's their goal. Well, they know, just like Mark just said, they know that they have to crush demand. How do they do that? They raise interest rates, okay? So that makes people borrow less, from the consumer up to the corporations. They'll borrow less. It'll just decrease productivity, and it'll decrease the amount of demand. But you get to the point where the interest rate gets high enough, and enough debt has to be reissued, right? So you have debt that's going to expire, it's going to mature, that you have to reissue more debt in order to keep operating. Well, maybe that debt is a little bit too high for you to operate at. Maybe demand comes down just enough that you do what happens is you trip a covenant and you don't make enough money to cover those expenses on interest, that the lender will call that debt. and they'll wind up owning your company. And what do? They're going to fire people. Okay, so when you hear full unemployment, just remember that these things happen in stages. Okay, so we will get to a point where a number of companies will start to falter or go out of business. They'll start to cut back employees, and then you're not going to see it happen until we actually enter a recession where the unemployment spikes, and it happens every single time. You don't see unemployment spike before a recession. It's a lagging indicator, exactly. But the Fed knows this. So the Fed knows that they can just keep tightening and keep tightening and keep tightening, and Powell has said it over and over again. They have tools to deal with a recession. They do not have tools to deal with hyperinflation. So he's not scared about a recession, and that all of us could be casualties to the job market and to productivity and to earnings. He doesn't care. He knows that he can swoop back in, enter the QE program again, flood the market with liquidity, and start that inflation engine going again.
Okay, so let me ask something, because it seems like the consensus among macro Bitcoiners is we're going to have a recession. The last one that I think was, most people in this room are very familiar with it feeling really deep and severe is the 2008 recession. I was part of the, 10 million American families lost their home. What will this recession feel like given the macroeconomic factors and all this debt in the system?
So I just want to follow up on James's point, and then I'm going to touch on that. So one of the things that I think I got really wrong, like if I had to go back 2 years ago, was the speed at which them hiking rates, like the impact that was going to have on the economy. I kind of suspected that at best they could do it a year and then things would really start to break and fall apart. And this has been way more resilient than I had ever imagined. Now, it's real easy to Monday morning quarterback the why, and for people that are wondering what the why is, when you look at 0% interest rates and how long they stayed there, and you look at the incentive that's around 0% interest rates, businesses are highly incentivized to load up on as much of that as they can possibly gobble up, some locking in 5-year terms or longer, because when it's 0%, you want to lock it in as long as you possibly can. I'm sure a lot of people in here maybe refied their house at really low interest rates, and if they could give you 100 years, you would have taken a 100-year loan instead of 30, right? So you had a lot of this happening across the whole spectrum, whether it was an individual, a company, or even municipalities that took on this really cheap and low interest bearing debt. The reason that this is able to be persistent for so long is because none of them are rolling any of that debt. You can see this, everybody in this room, how many people went out and refied their house since the rates started going higher, and pretty much nobody's going to raise their hand. Same thing for companies and corporations. So you're on this shot clock where some of this debt that people have borrowed is going to mature, especially if it's 5 years or 3-year terms on this debt. Once that rolls over, and you're seeing it with the Treasury already, they're experiencing it firsthand because we're seeing the amount of issuance that they have to do because the rates are higher and what that tail looks like at the federal level. But you're going to start seeing that at the individual level, and you're going to start seeing that at the corporate level, and it's going to start to manifest itself. And, my guess where it really gets nasty is by 25, if I was, just to bet. And I've heard that a lot of these companies are going to have to start rolling at 24, 25 at much higher rates. And so that's where a lot of this is going to start taking hold. So with respect to Natalie's question, which is, what does this look like? And this gets extremely difficult for me to answer. And the reason why is because it really comes down to you got so much buying power nested into the fixed income bond market. You're just talking trillions of buying power globally that's stuffed into that type of vehicle. And as the math continues to mature, and more people, it becomes the consensus that there's no way any of these G7 countries can actually get this under control. And they're pulling that buying power out of that thing because they know it's going to continue to get debased and get crushed. Where does somebody stick that buying power? Well, most individuals, especially the boomers and the people that are controlling a lot of this buying power around the world, where they're going to stick it is in companies that can actually still produce free cash flows, and they're just going to bid those PEs to the moon. They're going to buy that equity. You're going to see PE ratios that you didn't even think were possible because there's really nowhere else to go. You're going to see gold get bid. You're going to see Bitcoin get bid. Not everybody's going to be able to wrap their head around this initially, but as the time continues to march on, I think it's going to become more and more obvious just through the price action as to where that goes. Now, if you're a business that can't produce free cash flows, which gets really, really hard the further you go to the right on the timeline with all of these dynamics playing out of higher interest rates, inflation, and everything, those businesses that are not generating free cash flows, they're going to get wrecked. They're going to absolutely get wrecked. And as the government steps in and tries to subsidize this by controlling the price of money through yield curve control, and I would argue quasi-yield curve control has already happened with some of these backstop facilities because they're not allowing the prices of bonds to drop any lower. Just put them on deposit over here if you're running into issues. That's a whole nother terminology argument that we could get into. But long story short is, the few businesses that continue to have free cash flows, they're going to consolidate the equity. They're going to buy up any other mid or small cap company that can produce free cash flows, and they're going to do it more easily because they're becoming more and more dominant. Almost like when you're playing a Monopoly game, and let's say the four of us are playing, and let's say any one of you guys are starting to dominate the game. Let's say James is dominating the game, okay? It'd be like going up to that game and watching and looking at James holding all the properties and saying, yeah, I don't think he's gonna monopolize the board at this point and start taking the property. Get out of town. He's gonna buy all these properties from the rest of us, and at the end of the game, it's not linear, it's parabolic, and it starts taking off. So I think you're going to start seeing some of those things really play out in 24 and 25, where it really, you see consolidation of equity. You see this disparity that really starts to express itself even more than what you're already seeing.
Yeah, I think that's generally probably what I would also view it as well. I think, it's really important to understand, to kind of, as I said, like, this is the macro picture, it's the big picture, and so trying to understand the directionality. And so some of these things, there's just no option. The Treasury admitted it's an unsustainable path. There's no other option. Do you think the governments print more money or less money in the future? I mean, there's just no choice. And so that leads to one thing. So that's the direction. Now, what happens within that time frame is up for debate. I always like to refer back to, there's a great book written, When Money Dies, and they talk about the hyperinflation through Weimar Republic, Germany. And you guys have probably seen the chart. It's been used many times. It was the German mark to gold ratio. It was over a 9-year period. It just went up parabolic like a hockey stick. And then there's an overlay with a red overlay that shows the volatility that was within that, right? So like, that was a 9-year trade. Just step out of the marks, buy the gold, come back 9 years later, you crushed it. But if you were living within that, the volatility was so extreme that most people were shaken out over and over and over. And in the book, they talk about how people had never seen their asset prices so high. Their gold had never been worth so much. Their house had never been worth so much. They needed to sell those assets before they came crashing back down because it was going up, down, up, down, up, down. So they did. So they sold all their assets before they crashed back down, and they ended up holding a bunch of worthless paper that was worth so little, they burned it in the fireplace because it was worth less than wood. And so I think that's sort of where we're at, right? In Zimbabwe, everybody became a billionaire, but eggs were 350 billion. And so I think, what happens in the next, 6 months to 12 months is anybody's guess. Looking at all the data we have, the inverted yield curve, which could stay inverted for another year, we don't know. But there's probably a big liquidity crisis in front of us. We can see at least a dozen, whatever, gray swans in front of us. But what comes next is probably a liquidity stream that we haven't even imagined. And so the bigger problem is, how do we keep our head above water as that inflation rises? If we're looking 3, 4, 5, 7 years out, I think, in my opinion. So I think there is probably a big liquidity event coming in the next 12 months, it seems like. We know that, historically, when we see massive rate increases by the Fed, it takes about 18 months for them to start to show up in the system. So we're going to be there here at the end of the year, going into next year. And so there's probably a big liquidity event. I think it's probably like a V-shaped deal, sort of like we saw in 2020. Probably not a tradable event, in my opinion, unless you have some dry gunpowder ready and your finger on the trigger. But then the question becomes, how do we keep our head above the water as that inflation rises? I think Bitcoin, any scarce assets are always going to do good. We saw, for example, Austin that we're in right now has been the fastest growing city in the last 20 years. Over the last 3-4 years, real estate's gone up by 40%. But on Lake Travis, lakefront property went up by 150% because it's scarce assets. And so Bitcoin, I think, is going to be one of those lifeboats that will keep our head above water.
Yeah, I would absolutely agree that the liquidity event that Mark is referring to, I'd say it's a credit event. And what I mean by that is that eventually, after 18 months of raising rates or whatever it is, after 24 months of the inverted yield curve, we finally get to the point where you have a major company or a major credit event. Company fails, or an insurance company, or another major bank, or something that we're just not expecting. And it causes something that we call, like I was saying before, contagion, where it will take down a major number of large players. And if any of those players are anywhere near what are considered the globally systematic important banks, the GSIBs, if they're anywhere near that, then we're going to see the U.S. Treasury and the Fed, get together, print money, and start monetizing assets again. Why? Because the Treasury market must continue to operate. Why? Because the U.S. must continue to float treasuries to operate. Why? Because we're completely fiscally, we're fiscally, I want to say a word that I can't really say it here, but you guys know what I mean. We're FUBAR, right? So, but because we operate in such a perpetual deficit, there's no way that we can let the Treasury market lock up. And so it all comes back again to the money printing, to expansion of the money supply, to expanding M2. And that means that you have to protect yourself, like Mark is saying, keep your head above water. How do you do that? You own assets that will appreciate along with that money supply expansion.
Buy Bitcoin. That's what I'm hearing from this. Okay, I think we're going to have to wrap this up, but we might have time for one question. Anyone? Quick question? Puppy,
come on.
Say it. We'll repeat it.
we're gonna have to ask that behind the stage.
We're behind time.
I think his question is, when will the debt be paid back? And the answer is never.
Yeah.
Never, Laura, never, yeah.
I think it's hidden in inflation, the most pernicious tax of all.
So when you look at the CPI, right, I can make CPI anything you want it to be. You want it to be 80%, you want it to be negative 3%. I can just go in there to all the different categories and I can just weight them however I want to produce whatever number you want. And this is Michael's brilliance where he's talking about inflation's a vector. And he talks to like, your inflation is different than yours because your spending habits are different than his. So if I'm sitting at the government and I want to try to manufacture numbers, You can look at the UK, you can look at what's being reported, you can look at what they're actually, an everyday person is experiencing who has a house payment, a car payment, medical bills or whatever, and it's grossly different than what the reality is. So that's how, I would argue that's how they hide it, is through the weighting of the various categories.
Basically, we're being gaslit. Sorry, guys, we're out of time, but give it up for this panel. Sorry.
Grandpa, why do you have so much Bitcoin?
Well, it all started in the year 2023 when I attended a conference called BitBlockBoom.
What's BitBlockBoom, Grandpa?
It was a conference where people talked about Bitcoin. This was way back when we used something called the US dollar for money.
What? Bitcoin wasn't always the world's money?
If it weren't for great speakers at BitBlockBoom like Jimmy Song, Adam Curry, and Preston Pysh, we'd all be living in pods and eating bugs. Instead, I was able to avoid fiat enslavement and secure generational wealth.
F***ing legend.
Be the legend your grandchildren deserve. Experience the best Bitcoin conference out there and join the Bitcoin revolution. BitBlockBoom, the only conference for true Bitcoin maximalists. Book your tickets today at bitblockboom.com and use the code BBB1 for a special discount.